Welcome back to Morning Markets on the first day of September. And today I wanted to provide a quick overview of what happened in markets through the month of August. It was a strong start to the month. However, as we moved through into the mid part of the month, evidence that inflation was proven to be higher, stickier, and more broader in terms of its readings became evident. And markets were pricing that into their expectations. Central banks were responding in terms of their rhetoric. They were making clear that they were sticking on their pathway of monetary policy tightening, raising rates, and reducing the size of bonds which they have on their balance sheets to bring inflation under control. And this was particularly clear in some of the rhetoric in terms of the US Economic Forum, which came out of Jackson Hole towards the end of the month. The challenges of the war in Ukraine continued, and that induced volatility through the commodity markets, particularly gas prices into Europe. Whilst oil prices moderated, which was slowly feeding through into lower prices in terms of gasoline and petrol, gas prices, as I say, have continued to push on. And even the UK, we felt this with the rise in the Ofgem energy price cap. The numbers on screen highlight the extent of those market moves and those challenges. Global equities in local terms were negative, but in terms of sterling, they were relatively flat. Global bonds and corporate bonds down between 2 and 3% through the month. And as I suggested, it was a particularly tough month for sterling. The pound actually weakened around 5% through the month relative to the US dollar and around 2.5% relative to the euro. For context, that's the biggest single move in a month since the 2016 Brexit vote. The challenge here sits with how markets anticipate the new Tory leader will attempt to grapple with rising living costs to the consumer. At the same time, the central bank are trying to raise rates and tighten policy to manage inflation, and that induced bond yields to move higher through the course of the month. At True Potential, we are multi-asset. That means that we are investing in a broad suite of instruments and tools away from just those headline figures which I've just highlighted there. And whilst the markets reacted to the price challenges adversely, this month provided a number of reassuring data points which are longer term in terms of their nature. Labour prints, as an example, are remaining very strong. In the US, there are 2 job postings for every available worker out there. Chinese central banks offered further support to the economy, reducing the cost of mortgages for the domestic consumer. We saw early signs that core inflation in the US was starting to peak and moderate. After several years of saber rattle, and we had the Statement of Protocol, which was signed between the US and China, essentially allowing US accountancy practice boards to audit Chinese companies listed in the States, a situation and a challenge which has been going on for many years now. We've got some real progress there. Through August, I mentioned Jackson Hole and a number of central bank rhetoric statements. Essentially, there was no formal meeting from central banks in August. They were on summer breaks. What we get in September is back on track. We have central banks meetings, we'll get formal guidance, formal agendas, and we'll get formal decisions in terms of how they're going to deal with the inflation. So volatility around the rhetoric. On September, we get some formal guidance, and we look forward to bringing you up to date throughout all of those stages in the month of September here on Morning Markets. Thank you for watching.
If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.